Welcome to the Deep Dive, where we tear apart complex corporate reports, sift through hours of calls, and pull out the exact insights you need to be perfectly informed.
And today, we're tackling a really fascinating financial puzzle.
We're jumping into the Lennox Q3 2025 earnings call. This one was delivered on the morning of October 22nd.
And, the puzzle here is that Lennox, the HVAC giant, reported a record Q3 adjusted EPS. Their operating margins expanded. On paper, a huge win for profitability.
But the stock dropped. And not just a little. It plunged over 10% on the day.
A huge disconnect.
Right. So the market clearly was not celebrating their operational wins. It was completely fixated on something else, forward guidance and a pretty serious contraction in their top-line volume.
So our mission for you, the learner, is to resolve that contradiction. We're going to figure out why the market penalized a company that actually beat its profit estimate.
And what that deep cut to their full-year outlook tells us about the underlying health of the entire HVAC industry as we head into 2026.
To really get it, you have to start with the results snapshot. It really lays bare this tension between profit and volume.
Okay, so let's get the numbers on the table. What's at the center of this storm?
Well, on the profit side, the story was, frankly, stellar. Adjusted EPS hit a record for Q3 $6.98.
Which beat estimates.
Comfortably. It was a 1% to 2% profit surprise, and it was driven by exactly what you want to see in a choppy environment. Cost control and pricing power.
Okay, so far so good. But the revenue side of the story was the complete opposite.
Exactly. Revenue came in soft, $1.43 billion. That missed estimates by somewhere between $50 and $70 million.
And that's a 5% decline year over year.
Right. A revenue miss is never good, but this is just the preamble. The real source of the market panic was the guidance cut.
This is where the hammer fell, right? When management updated their full year 2025 outlook.
Oh, it was dramatic. They had to revise the entire expectation for the year. Revenue guidance, which had started out projecting about 3% growth, was slashed all the way down to an expectation of a 1% decline.
Wow. And the EPS guidance?
That followed suit. It was trimmed from a high of around $24.25 to a new lower range of $22.75 to $23.25.
And maybe most critically for cash, the free cash flow guidance was revised sharply down.
And FCF is crucial, right? It tells you how much actual cash the business is generating. The old range was a pretty healthy $650 to $800 million.
And the new one?
Approximately $550 million. That's a cut of between $100 and $250 million.
That FCF revision is where the volume and profit story really collide, isn't it? It's the first big clue as to why the market freaked out.
It is. That loss of volume translated immediately into a cash flow problem. We'll get into the mechanics of that later, but the message was just loud and clear.
The bad news on volume and guidance completely drowned out the good news on the earnings beat.
Management basically framed 2025 as a, quote, transitional year. They pointed to two big headwinds, channel destocking and his A2L regulatory friction.
Okay, let's start with the biggest source of the pain, which was their residential segment, Home Comfort Solutions, or HCS.
The numbers here are just stark. HCS revenue fell 12%. But what's even more concerning is if you look at the unit sales, the actual boxes going out the door.
How bad was that?
That was down a staggering 23%, just way more than management had anticipated.
A 23% drop in units that's massive. Is that just the usual suspects? Soft housing market, low dealer confidence, or was something else going on?
That's the right question. Because, sure, the macro weakness plays a role. People hold off on a huge HVAC replacement when home sales are low. They'd rather just repair the old unit.
Right.
But the big surprise, the reason for that huge 23% drop, was an inventory dynamic that management admitted took them, and I'm quoting here, a little bit by surprise.
Okay, so let's get into that destocking surprise. This seems to be the key to understanding if this is a temporary problem.
It really is. So think back to the peak of the pandemic supply chain crisis.
Yeah.
All the contractors, the distributors, they were terrified of running out of product.
So they hoarded.
To guarantee supply, contractors were literally renting barns and storage units to create their own personal stockpiles of HVAC units.
Like HVAC PTSD from 2021.
Exactly. But now, industry lead times have completely normalized. You can get a unit in 1 or 2 days. So that need for a giant personal stockpile, it's gone.
So what we saw in Q3 was thousands of these dealers just clearing out all that old expensive inventory from their barn instead of buying new systems from Lennox.
Precisely. And that is a powerful temporary and non-recurring drag on volume.
Okay, that context makes the volume weakness feel much more like a timing issue than some kind of fundamental collapse in demand. And then on top of this, they mentioned the A2L bottleneck. Can you just quickly clarify what A2L is for us?
Sure. A2L is just shorthand for the big regulatory transition to new refrigerants, the stuff that cools the air. The industry is moving to refrigerants with a lower global warming potential.
And this involves all new equipment, new procedures.
Right. And that regulatory shift caused massive hesitation from dealers. They were worried about supply chain friction, specifically getting their hands on canisters of the new refrigerant.
So if they install a new system, they were worried they couldn't get the supplies to service it.
Exactly. So what did they do? They delayed sales. They pushed customers to just repair their old units instead of dealing with the headache of a brand new system.
That makes perfect sense. The good news, though, is that management said these A2L issues are now, quote, firmly behind us.
Right. Which again points to this being a temporary issue. But it does confirm that trend toward repair over replacement. They're seeing it in their parts and supplies sales, which are actually growing.
Which is a higher margin business for them anyway.
Much higher margin business.
So let's pivot now to the other side of this, the margin resilience. Because despite revenue falling 5%, the operational story was, well, it was incredible.
It really was. The overall operating margin expanded by 150 basis points year over year to 21.7%.
How on earth did they do that while volumes were just collapsing?
This is the structural strength that I think the market just completely ignored. It was driven by three things: a favorable product mix, successful pricing, and just rigorous cost management.
So even though the A2L transition was a pain for volume, the new products themselves commanded better pricing.
Yes, and helped margins. And on top of that, they were just laser focused on what they could control, cutting selling and administrative expenses.
And their commercial business, Building Climate Solutions, or BCS, that was a real standout, right? It acted like a safety valve.
Absolutely. BCS delivered 10% revenue growth and expanded its profit margins by a remarkable 330 basis points.
Wait, but you said the broader commercial HVAC market is actually shrinking. How did Lennox grow 10% in a shrinking market? That's a huge outlier.
It is, and that's a fair challenge. It looks like they're capturing high-quality market share, not just buying it with discounts. A big factor was huge growth in emergency replacements.
When a commercial unit on a building fails, it has to be replaced no matter the economy.
Exactly. They saw nearly 100% growth in that niche. It's still a small base, maybe 5% of BCS revenue, but it's growing fast. And they also saw strong growth in high-margin refrigeration and service offerings.
So it's a very deliberate strategic shift toward more resilient, less cyclical revenue streams.
That's what it looks like. And they're doubling down. They confirmed they're planning the customary annual price hikes for 2026, and they're also actively rationalizing their lowest margin residential new construction business.
Meaning they're walking away from some low-profit sales on purpose.
On purpose. They're targeting the bottom 10 to 15% of that RNC volume. It's a choice to improve profitability, even if it creates a small revenue headwind in the short term.
This all brings us back to the market's main worry, the financial mechanics of that guidance cut. Why should you, the learner, care about that $100, $250 million drop in free cash flow?
Because it is the direct consequence of that inventory overhang. Remember that sudden drop in sales? Yeah. Well, the product didn't just disappear. It had already been made, and it ended up sitting in Lennox's finished goods inventory. Management said that's about $150 to $200 million of extra inventory on their balance sheet.
And that inventory is basically cash tied up on a shelf. It's not free cash flow until they sell it.
Precisely. And that has an immediate knock-on effect on manufacturing. You have to right-size the inventory.
Which means you have to cut production.
Correct. Lennox is cutting back manufacturing in Q4. And this creates a very specific financial problem called a manufacturing absorption headwind.
Okay, we need to explain that. What exactly is a manufacturing absorption headwind, and why does it lead to a 20% decremental margin?
Think of it like this. A factory has fixed costs, rent, salaries, machinery. Normally, you spread those fixed costs across, say, 1 million units you produce. You absorb the cost.
Got it.
When you suddenly cut production way back, you have those same fixed costs, but now you're spreading them across far fewer units. So the cost per unit just skyrockets.
So even though they're selling fewer units, the cost to make those units is temporarily much higher, which hammers their profit in Q4.
Exactly, that's the decremental margin impact. The good news is they expect this whole inventory normalization process to be done by the end of Q2 2026.
Which again confirms this is a timing problem, not a forever problem.
Right, and while they're managing all this, they were still active on the acquisition front. They closed a deal for NSI Industries HVAC division.
This includes brands like Duradyne and Subco.
And this is another critical strategic move. It strengthens their high-margin parts and aftermarket business. This is the stuff for repairs, which, as we said, is growing.
And why is aftermarket so attractive?
It's a higher multiple business, it's less cyclical, it's more recurring, and it has much better gross margins. Management said the NSI business has EBITDA margins around 25%.
And it should add 30 to 40 cents to EPS in 2026.
So this fundamentally makes the company less dependent on the wild swings of new equipment sales.
Which all sets up the big thesis for 2026. Despite the pain now, management sounds pretty confident about a return to growth next year. What are the catalysts?
They laid out four main reasons. First, the big negative goes away. That channel inventory mess should be cleaned up by Q2. Second, they expect a recovery in home sales as interest rates potentially fall, which unlocks pent-up demand.
And third, the A2L transition mess fades, so dealers get their confidence back and start pushing new systems again.
And fourth is structural growth. They have new joint ventures like Samsung ductless products and Ariston water heaters, which should add half a point to a full point of growth every year. They see the whole industry volume getting back to a normal 9 to 10 million unit range.
All right, that brings us to our not financial advice segment, where we pitch an outrageous but plausible trade idea based on the gall.
Okay, let's hear it.
The trade thesis is simple. Long Lennox, short housing pure plays.
Wow. That's high conviction given the stock just got destroyed because of housing and volume fears.
Yeah.
Why buy this dip right now?
Because the market reacted entirely to the cyclical drag and completely ignored the fundamental structural improvements. My thesis is the pain is temporary, but the higher margin structure is permanent.
Okay, so lay out the plausible argument for me.
The market values Lennox based on residential volume, which is weak, right? But the real strategic value is shifting to these more resilient revenue streams that deserve a higher multiple.
Like the commercial business.
Exactly. BCS grew 10% and expanded margins 330 basis points in a down market. The NSI acquisition is a high-margin, recurring revenue business. The core volume problem is explicitly temporary destocking, yet the market is pricing it like it's permanent demand destruction.
So the outrageous part of the trade is that you believe the floor for their profitability is now structurally higher than the street realizes. You're betting their internal execution matters more than the external cycle.
Precisely. The bet is that when the volume rebounds in 2026, you combine that with this new higher margin structure, plus another $10 million in productivity from their new Saltillo plant, and you get a powerful double trigger upside. It justifies buying this panic-driven dip and ignoring the noise from contractor-rented barns.
Okay, so to recap our deep dive, we covered the Q3 results, a record profit picture that was just completely overshadowed by the deeply revised guidance.
And that guidance cut caused the double-digit share decline because the volume loss hit free cash flow and created that Q4 manufacturing headwind.
So the key tension here for you, the learner, is understanding this difference between structural strength and cyclical weakness. The company executed perfectly on profitability, but the external world destocking, housing, A2L, it all created this overwhelming short-term volume problem.
Which leaves us with this final provocative question for you to think about. Management expects industry volume to normalize at 9 to 10 million units in 2026.
So if that happens, and if their margins stay resilient above 20% because of these strategic shifts into high-margin parts and commercial replacement, does Lennox emerge from this inventory hangover as a fundamentally higher quality, structurally stronger business, deserving of a much higher valuation once all this cyclical dust settles?